I want you to understand what is happening in the market right now without being hypnotized by the rally, because that is the danger. When prices fall, people become too fearful. When prices recover quickly, people become too confident. Both states can make you stupid. The S&P 500 and the Nasdaq have recovered sharply. Bitcoin has moved from deep fear back towards strength. Large cap technology stocks are being bought aggressively. Investors who are waiting for the perfect moment are now watching prices move without them. On the surface, it looks like the system is healing, but when I study a system, I do not ask only what prices are doing. I ask why prices are doing it. I ask whether the cause is durable. I ask what risks remain unresolved. I ask what the crowd is assuming that may not be true, and right now the answer is very clear. This rally is not an all-clear signal. It is a relief rally built on the belief that the worst-case scenario may have been avoided for now. That is very different. Markets are reacting to the extension of the U.S.-Iran ceasefire, strong corporate earnings, and the continued belief that artificial intelligence is the most important technological transformation of our lifetime. Those are real forces, but the underlying risks have not disappeared. Oil is still high. The Strait of Hormuz risk is not gone. The Middle East is not settled. Inflation can return faster than investors want. The Federal Reserve may not be in a position to ease policy as quickly as markets would like, and the same investors who are celebrating today may be forced to reprice risk tomorrow if one of those variables turns against them. So the first principle is this: a rally can be real and still be fragile. A market can move higher for valid reasons while the macro foundation underneath it remains unstable. If you do not understand that, you will either stay too scared and miss opportunity or become too euphoric and take reckless risk. The goal is neither fear nor euphoria. The goal is to see the machine clearly. Let us begin with why the market is rising. The most immediate reason is that investors are preemptively relaxing after the ceasefire extension between the United States and Iran. Markets are forward-looking. They do not wait for complete peace. They do not wait for perfect resolution. They move when the probability of catastrophe appears to decline. If investors feared a wider conflict, oil shock, shipping disruption, and direct military escalation, then even a temporary truce can create a relief bid. That is what we are seeing. The market is not saying the world is safe. It is saying the worst immediate outcome looks less likely than it did before. That difference is enough to move asset prices. This is how markets work. They are not moral. They are not patient. They are not waiting for a full historical verdict. They price probabilities. If the probability of the worst case falls, risk assets can rise quickly, but that creates a dangerous illusion for ordinary investors. The price move makes them feel as if the problem is solved. It may not be solved. It may only be postponed. The Middle East remains unstable. The supply risk in the Strait of Hormuz remains important. Iran's position has not fully changed. The United States still has strategic objectives. Oil markets still care about shipping lanes, production risk, and geopolitical escalation. So the first part of the rally is relief, not resolution. That distinction matters. The second force is corporate earnings. Strong earnings can support markets even when the macro picture looks messy. This is because stock prices are ultimately tied to expected future cash flows. If large companies keep earning money, keep expanding margins, and keep showing growth, investors are willing to pay higher prices. This is especially true for the biggest technology companies because they dominate the index. The S&P 500 is not an equal representation of every household's experience. It is heavily influenced by the largest companies. If those companies are producing strong earnings, the index can rise even while many ordinary people feel pressure. This is why the market can feel detached from real life. It is not because prices are fake. It is because the index is measuring one part of the economy, not the whole lived experience of the average person. The third force is AI. Artificial intelligence is still holding the market together. Every time the market begins to doubt the future, AI optimism reappears. New model updates, new infrastructure spending, new productivity forecasts, new capital expenditures from the largest technology companies, new fears that if you are not positioned now, you will miss the greatest wealth transfer of the next decade. This is powerful because AI is not just a technology theme anymore. It is becoming an economic regime. It affects labor, it affects productivity, it affects corporate margins, it affects data centers, it affects chips, it affects energy, it affects software, it affects consumer behavior, it affects government policy, it affects the entire distribution of wealth between those who own the machines and those whose work is replaced by them. That is why the AI trade has such emotional force. Investors are not merely buying companies. They are buying exposure to the belief that the structure of the economy is about to change, and I think that belief is directionally correct. But even correct beliefs can become overpriced. The internet was directionally correct in the late 1990s, and many people still lost money because they bought the wrong assets at the wrong price. So again, the principle is balance. Recognize the technological revolution. Do not assume every asset connected to the revolution is a good buy at any price. Now, the source document makes a point about the market being irrational and greedy. I would frame it slightly differently. Markets are not irrational all the time. Markets are adaptive. They are made of people, institutions, algorithms, positioning, incentives, leverage, liquidity, and fear of missing out. At any moment, prices reflect not only fundamentals, but also what people believe other people will do next. That is why markets can move before the news is fully resolved. It is why every dip can be bought aggressively when investors believe the long-term trend remains higher. It is why retail investors can feel afraid while institutional capital begins positioning for the next leg. It is why the same headline can be interpreted as bearish one day and bullish the next. The market is not a calculator. It is a voting machine in the short term and a weighing machine in the long term. In the short term, emotion and positioning matter a lot. In the long term, cash flows, adoption, productivity, and monetary conditions matter more. Your job is to avoid being destroyed by the short term while positioning intelligently for the long term. That is not easy. The source document points out that many retail investors believe global stock markets will be higher in 12 months. Many plan to invest significant money. Many believe Bitcoin will be higher. Many are planning portfolio overhauls while also increasing cash reserves. This tells you something important. People are conflicted. They want upside. They also fear downside. They believe in the future. They also want dry powder. That is a rational emotional state in a fragile rally. The perfect scenario for many investors would be a 20% correction that lets them buy at lower prices before the next major move higher. But markets do not owe anyone the perfect entry. This is one of the most expensive lessons in investing. Waiting for the perfect dip can become a form of paralysis. If the dip comes, most people become too afraid to buy it. If the dip does not come, they stay on the sidelines while prices rise. This is why a systematic approach is usually superior. Dollar cost averaging solves a behavioral problem. It does not guarantee the best price. It guarantees participation. And participation matters when you are living through a period that may involve one of the largest technological transformations in modern economic history. If you are in the wealth accumulation phase, doing nothing can be more dangerous than buying imperfectly. That does not mean deploy everything at once. It means build a system, invest recurring amounts, hold cash reserves, add more aggressively if a major correction comes. Do not let the desire for the perfect entry prevent you from owning assets that may benefit from long-term technological and monetary change. The simple approach is this: keep a base level of exposure, keep liquidity, use corrections as opportunities, avoid panic, avoid all in emotion. This is not glamorous. It is effective. The source document frames it as a left curve and right curve move. In cleaner terms, the most basic and the most advanced answer can sometimes be the same. DCA into the strongest long-term opportunities and keep reserves for deeper dislocations. The difference is that the beginner does it because it is simple. The advanced investor does it because he understands that prediction is limited and survival matters. Now let us talk about why sitting on the sidelines may be especially dangerous in this cycle. The world may be entering a period where AI changes labor faster than most people are prepared for. Elon Musk has talked about government checks or universal high income as a response to AI. Driven unemployment, Sam Altman has pushed versions of universal basic income or universal basic wealth. Governments have begun discussing support systems for workers displaced by automation. You do not need to agree with every forecast to understand the implication. The people building the systems believe the labor market may change dramatically. If they are right, the next decade may create a wide gap between those who own productive assets tied to AI and those who only sell labor into an economy where labor is being automated. That is the wealth transfer. Not because money falls from the sky, because ownership becomes more important when labor income becomes less secure. If AI creates abundance, the owners of the AI infrastructure, the models, the data, the compute, the chips, the energy systems, the platforms, and the financial rails may capture a large share of the gains. If you do nothing, you may become a consumer in someone else's machine. If you prepare, you may own part of the machine. This is not about fantasy, it is about incentives. Capital owns machines. Machines raise productivity. Productivity creates profits. Profits accrue to owners. If labor is displaced and capital becomes more powerful, then asset ownership becomes more important, not less. That does not mean everyone should speculate wildly. It means the cost of owning no assets may rise. The future may be more unequal if ownership is concentrated. Therefore, building ownership now matters. Stocks, Bitcoin, gold, international exposure, growth companies, AI infrastructure, crypto infrastructure, each has different risks. But the broader principle is diversification across assets that can protect you from a future where wages alone are not enough. This is one of the most important ideas in the source document. Finances determine options. They determine neighborhoods, schools, security, mobility, the ability to handle large problems. Money does not solve every problem, and it does not create meaning by itself, but lack of money makes many problems larger. That is reality. It is better to be honest about that than to pretend otherwise. Now, let us step back and look at the 5 real needle movers that matter right now. The first is the war risk around Iran. The source document lays out the conflicting objectives. The United States wants to stop Iran from maintaining highly enriched uranium and prevent further enrichment. It wants to reduce missile capability. It wants to keep the Strait of Hormuz open for oil traffic without Iranian limits or tolls. Iran wants the war ended. It wants sanctions lifted. It wants compensation. It wants control and authority over the Strait of Hormuz. It wants to continue uranium enrichment. It wants US forces reduced or withdrawn from the region. These objectives do not fit together easily. That is why the most likely path may be a messy middle, not full peace, not full war. Intermittent escalation, negotiations in the background, shipping risk, tension around oil, small incidents that markets react to. This messy middle matters because markets can tolerate uncertainty if it does not become uncontrolled. They can rally through tension. But if tension turns into a direct shock to oil supply, the market reaction can change quickly. So the first question to ask about any Middle East headline is not whether it sounds dramatic. The question is whether it changes the probability of a wider conflict or a disruption in oil flow. If yes, it matters. If no, it may be noise. The second needle mover is oil. Oil is the fastest transmission mechanism from geopolitical risk into inflation. War in a faraway region can feel abstract to a household, but oil translates it into gas prices, shipping costs, fertilizer costs, food costs, and inflation expectations. If oil stays high, the Federal Reserve has less room to cut rates. If the Fed has less room to cut rates, risk assets face more pressure. If inflation rises, real incomes are squeezed. If margins are squeezed, corporate earnings may be pressured. If consumers weaken, the economy becomes more fragile. This is the chain. Oil is not just an energy chart, it is a macro transmission belt. For a durable broad bull run, oil likely needs to stabilize or come down. If oil continues rising, liquidity can be pulled out of risk assets because inflation fear rises and policy easing becomes less likely. So when studying the rally, do not just look at the S&P 500, watch oil. The third needle mover is inflation and interest rate expectations. Rate cuts are fuel for risk assets. They lower discount rates, they stimulate borrowing, they support housing, they increase risk appetite. They can push investors toward equities, crypto, and growth assets. But rate cuts are only possible if inflation is sufficiently controlled or if the economy becomes weak enough that the Fed prioritizes growth over inflation. If oil keeps inflation elevated, the Fed may remain less dovish than investors want. The source document mentions Jerome Powell being replaced by Kevin Warsh and the possibility that a new chair could be more willing to cut. Leadership matters, but the chair does not operate outside reality if inflation rises. Even a more dovish chair faces constraints. Markets may price rate cuts before they happen. That is important. Risk assets can move when the probability of future cuts rises, not only when cuts actually occur, so the market can rally on changing expectations. But if those expectations are disappointed, the market can correct. Again, watch the probability path, not only the official decision. The fourth needle mover is company earnings. Earnings are the foundation of the equity market. Liquidity can lift valuations for a time, but earnings justify prices over time. If S&P 500 earnings expectations rise, the market has a fundamental reason to stay supported. If the largest companies keep beating expectations, investors may look through macro uncertainty. If AI-related companies keep showing growth, the index can remain strong. But if earnings weaken while valuations are high, the rally becomes more fragile. So the question is not only whether stocks went up, the question is whether earnings are improving enough to support the move. A high market can become higher if profits grow. A high market becomes dangerous if prices rise faster than earnings without support from liquidity. The fifth needle mover is AI optimism. This is the emotional and structural engine of the market. When investors believe the AI trade is intact, dips are bought. When investors fear that AI capex is overdone, competition is rising, or the technology is not as defensible as assumed, the market can sell off quickly. The source document references the DeepSeek shock and the large decline in NVIDIA market value around that event. The lesson is not about one headline. The lesson is that AI optimism can move hundreds of billions of dollars in market capitalization very quickly. The market is highly sensitive to whether investors believe the US AI leadership story remains intact. So if you want to understand the market, watch AI demand, model improvements, chip spending, cloud capex, data center build-out, energy constraints, and the competitive gap between us and Chinese models. Those factors matter because they shape the central growth narrative. Now, what does the current setup mean? The war risk looks less catastrophic than it did during the worst fears. Earnings remain strong, AI remains powerful, that supports the rally. But oil is still high, inflation risk remains. The Fed may not be able to ease quickly. That creates the possibility of another correction. This is why the market can go higher and still be risky. You must hold both ideas at once. Many investors cannot do that. They need one simple story, bullish or bearish, buy everything or sell everything. But reality is more complicated. A good investor can say, the long-term direction may be higher, but the short-term setup can still produce drawdowns. That is not contradiction, that is probability thinking. On a 2-year, 5-year, or 10-year horizon, markets may be much higher because of AI, productivity, liquidity, and the historical tendency of productive assets to rise over time. On a 2-week or 2-month horizon, markets can drop sharply if oil spikes. Inflation data surprises. The Fed disappoints or geopolitical risk escalates. Both are true. Your strategy must match your time horizon. If you are a long-term accumulator, DCA makes sense. If prices drop, you buy more. If prices rise, you still participate. If you are a trader, you need levels, invalidations, and risk controls. If you confuse those two roles, you get hurt. The investor thinks in decades, the trader thinks in setups. The mistake is to invest like a trader and trade like an investor. Now, let us move into the source document's second major theme, asymmetric opportunity. An asymmetric opportunity is one where the potential upside is much larger than the downside. If the thesis plays out and risk is managed properly, these opportunities do not appear every day. They usually require several ingredients: a powerful narrative before the whole world fully understands it, a clear path for attention and liquidity to flow in, a market that has not fully priced the thesis relative strength during uncertain conditions, a catalyst or adoption curve, a structure that can convert attention into value, and most importantly, a disciplined plan for sizing and exit. The source document uses the example of Aerodrome, where the thesis was tied to Coinbase's base ecosystem before the broader market understood it. The logic was not random. It was a framework: find where a major platform is directing attention. Find the infrastructure asset that benefits if the platform succeeds. Find the asset before the narrative is widely recognized. Size aggressively only when conviction, liquidity, and risk-reward align. That is how large asymmetric returns can happen. But this is not easy. Most people hear the story after the big move and think the process is simple. It is not for every huge winner. There are many assets that never work. The difference is research, timing, sizing, and the discipline to sell when the thesis matures. Selling is often harder than buying. Buying early feels heroic. Selling into euphoria feels wrong because the crowd is telling you it will go higher forever. This is why people give back gains. They were early enough to win, but not disciplined enough to realize the win. The source document emphasizes that the biggest money does not usually come from overtrading or spraying capital everywhere. It comes from being more calculated. That is important. In bad or choppy markets, the best traders often do less, not more. They build watch lists, they study narratives, they identify relative strength, they wait for conditions to align, then they act aggressively when the setup is clear. Most of the year may be noise. A small portion of the year may offer the right conditions. This is similar to fishing. There are times when the tide is right, the fish are feeding, and almost everything works. There are other times when the water is pressured, the bite is slow, and forcing trades only burns energy. Markets are the same. There are periods when liquidity is strong and narratives explode. There are periods when everything chops sideways and traders get cut to pieces. Knowing the difference is part of the edge. Now, let us discuss the specific opportunity areas in the source document. The first is Bitcoin. Bitcoin remains the core crypto exposure in the source's framework. The thesis is that if Bitcoin stays above key levels, the long-term trend remains intact. The source document uses zones around 70,000, 60 to 70,000, and 50,000 as buying zones or levels of conviction. I will not treat those as recommendations. They are part of the source's structure. The deeper principle is that strong investors define levels before emotion takes over. They do not wait until the market drops and then ask, should I buy? They decide in advance. If price reaches this zone and the thesis remains intact, I buy. If it breaks this level, the thesis is weakened. If it confirms above this level, I add or hold. That is mechanical decision making. It reduces emotion. Bitcoin is volatile, so position sizing matters. The source document says Bitcoin can be a core exposure, but not necessarily the entire portfolio. That is wise. Bitcoin can rise dramatically. It can also fall dramatically if the position is too large. Volatility controls your decisions. If the position is sized correctly, volatility becomes part of the plan. The second area is hyperliquid and the hype token. The source document presents hype as a high-conviction altcoin thesis. The reason is not simply that the price went up. The reason is that the platform appears to have revenue, liquidity, user activity, and a structural buyback mechanism. It is described as generating significant annualized fees and earnings, with large total value locked and major perpetual volume. The important point is the business model. In crypto, many assets are pure narrative. They depend almost entirely on attention. An asset tied to real usage, fees, and value accrual can be different, not risk-free, different. If a protocol produces revenue, routes revenue into buybacks, expands into new markets, and captures trading volume, then the token thesis becomes more fundamental than a simple meme. The source document emphasizes that Hyperliquid is no longer only a crypto exchange for crypto pairs. It is becoming a venue for trading commodities, indexes, and equities on-chain, with oil, gold, silver, SP 500 futures, NASDAQ indexes, and large equities becoming part of the platform's activity. If true and durable, that expands the addressable market. It shifts the thesis from crypto, native speculation to broader financial infrastructure. That is why the asymmetric argument exists. The market may still be pricing it like a crypto asset while the platform is trying to become a broader trading layer. The next catalyst mentioned is prediction markets through HIP-4. Prediction markets have become a major category. If Hyperliquid can integrate prediction markets with existing margin, liquidity, and user behavior, then fee growth may expand further. Again, the thesis is not guaranteed. The source document also identifies a key risk: validator decentralization. If a network has too few validators or meaningful centralization concerns, credible neutrality can be questioned. That matters because long-term financial infrastructure requires trust. If users believe the network is too centralized, regulatory, technical, or governance risks may grow. So the hype thesis has both upside and risk. The disciplined investor must hold both. The upside is revenue, liquidity, buybacks, expansion into traditional assets, prediction markets, and relative strength. The risk is centralization, competition, regulatory uncertainty, crypto volatility, and valuation. The third area is described in the source document as a treasury company tied to Hyperliquid exposure. This is a different type of play. Instead of owning the token directly, investors may get exposure through a public equity vehicle holding hype tokens and capital for further accumulation. The source frames as a traditional market wrapper around a crypto thesis, with experienced traditional finance operators involved, treasury holdings, deployable capital, and a potential equity line for accumulation. This type of structure can create leverage to the underlying asset and attract investors who prefer public equity access. But it also has risks. Net asset value matters. Premium or discount to NAV matters. Management matters. Dilution matters. Liquidity matters. Execution matters. Regulatory risk matters. If the vehicle trades near NAV, there may be less immediate valuation discount, but the narrative can still reprice if the market begins to value the structure more aggressively. This is similar to other crypto treasury companies, but each structure is different. The source argues that PER is structurally different because its underlying asset has operating income, yield, staking, or revenue. Linked economics. That may be important, but it must be verified and tracked. The fourth area is MicroStrategy. MicroStrategy is framed as a leveraged equity wrapper around Bitcoin. The thesis is simple: if you are bullish on Bitcoin, MicroStrategy may move with more torque than Bitcoin because of its treasury strategy, market structure, and equity wrapper. It has historically outperformed strongly during certain Bitcoin cycles, but leverage cuts both ways. MicroStrategy is not the same as holding Bitcoin. It has company-level risk, capital markets risk, premium fee discount risk, debt or financing structure risk, and volatility risk. If Bitcoin rises, it can amplify upside. If Bitcoin falls, it can amplify downside. A person should not own it casually without understanding that. The source document points to institutional price targets for Bitcoin in the future and argues that a move higher could make MicroStrategy powerful. Again, that may be true if the cycle aligns, but the correct framework is to treat it as a high beta Bitcoin vehicle, not a safe substitute for Bitcoin. The fifth area is Pengu, a meme coin or consumer crypto allocation. This is the most speculative part of the framework. The source document argues that each crypto bull run tends to produce a high-cap meme coin that captures mainstream attention. Dogecoin, Shiba Inu, and other examples are part of that history. The thesis for Pengu is that it sits at the intersection of liquidity, brand, retail attention, and consumer crypto narrative. But meme coins are extremely risky. They can move quickly, they can also collapse quickly. They depend heavily on attention, liquidity, community, and timing. They can be diluted by endless new tokens and shifting retail interest. So the disciplined approach is not to make a meme coin the whole portfolio. It may belong on a watch list or as a small speculative allocation for someone who understands the risk. The source document itself frames it as exposure to watch or trade when conditions improve, not necessarily as a whole portfolio position. That distinction matters. The sixth area is BMR, tied in the source document to Ethereum exposure through a public company or treasury structure. The argument is that Ethereum remains relevant and that a public vehicle with a strong promoter or recognizable figure can become a narrative trade when markets return. This is not a fundamental Ethereum only thesis. It is also a market structure and attention thesis in every cycle. Certain wrappers become vehicles for investors who want leverage to a crypto ecosystem but prefer equities or narrative structures that can create strong upside. It can also create extreme risk. A company with a famous promoter, treasury holdings, NAV dynamics, and cycle-driven flows can rise quickly and fall quickly. So again, watch list, research, sizing, risk control, not blind buying. The source document then ties the ideas together. Core Bitcoin exposure, MicroStrategy for leveraged Bitcoin exposure, Ethereum and Solana relevance. Treasury companies for ecosystem leverage, Hype as the high-conviction altcoin, Pengu as the memecoin watchlist play, Per as the structural traditional finance wrapper. This is a crypto cycle playbook. It is not appropriate for everyone. It has high risk. But the structure of the reasoning is useful because it shows how asymmetric investors think. They look for narrative, they look for liquidity, they look for catalysts, they look for relative strength, they look for adoption, they look for reflexivity, they look for where attention will return first when market conditions improve. They do not buy everything. They map the battlefield. Now, let us discuss one of the most important lessons in the document information overload. Today, retail investors have more information than ever. Social media, AI tools, newsletters, on-chain dashboards, podcasts, charts, research reports, Discord groups, X posts, YouTube videos, institutional notes. The problem is no longer lack of information. The problem is filtering. Too much information can create paralysis. People see every chart, every thesis, every warning, every opportunity, every crash prediction, every moon prediction, and they freeze. They do not know what matters. That is why the 5 needle movers are useful. War in Iran, oil prices, inflation and rates, company earnings, AI optimism. If a headline does not change one of those 5 variables, it may not deserve your attention. This is how you protect your mind. You do not need to react to every Bloomberg notification. You do not need to change your plan because of every viral post. You need to ask whether the headline changes the system. Does it change war escalation risk? Does it change oil? Does it change inflation or Fed policy? Does it change earnings? Does it change the AI thesis? If not, it may be noise. Filtering noise is a major edge. The market pays people who can focus. Most people cannot. They are pulled by every headline. They confuse activity with intelligence. They confuse reacting with managing risk. But the best investors and traders often do less. They wait for the variables that matter. They build conviction before the move, they define levels, they hold cash, they deploy when conditions align, they exit when the thesis is priced or broken. This is not easy, but it is teachable. Now, the source document also makes a point about crowd attention. Retail often arrives at the worst time. When markets are boring or difficult, people stop watching. When assets explode higher, they return. This is backward. The time to do research is before the crowd arrives. The time to prepare is when nobody cares. The time to build the watch list is during chop. The time to develop conviction is before price confirms. The time to sell is often when everyone is euphoric. You can use crowd behavior as a signal. If nobody cares and the fundamentals are improving, that can be interesting. If everyone cares and prices have already moved dramatically, that can be dangerous. This does not mean always do the opposite of the crowd mechanically. The crowd can be right for a while, but extreme crowd behavior contains information. Apathy can signal opportunity. Euphoria can signal risk. The investor's job is to read the psychology without becoming part of it. Now let us talk about grounding. The source document ends with a personal reflection about staying grounded, faith, clarity, and not being reactive in stressful seasons. In a Ray Dalio framework, I would translate that into principle-based decision, making markets test the nervous system. When money moves, identity moves with it. People become euphoric when they are winning. They become ashamed when they are losing. They become reckless when others are getting rich. They become frozen when uncertainty rises. That is why a person needs something deeper than price action, a set of principles, a grounding system, a clear understanding of why they are investing, a disciplined plan for risk. Without grounding, volatility controls you. With grounding, volatility becomes information. The principle is this: when you are rooted, you are less reactive. When you are less reactive, you make better decisions. Better decisions compound. This applies to investing, trading, business, and life. If your conviction comes only from price going up, it will disappear when price goes down. If your conviction comes from research, process, and alignment with your risk capacity, it can survive turbulence. That is why conviction matters. But conviction must be earned. It cannot be borrowed from someone else. If you hear a thesis from a video and buy blindly, you do not have conviction, you have exposure. When volatility comes, you will not know what to do. If you study the thesis, understand the risks, know the levels, and size appropriately, then you have something more useful. You have a decision framework. Now, what is the overall strategy in this environment? First, accept that the long-term direction of markets may be higher because of AI productivity, asset ownership, and the historical tendency of productive systems to expand over time. Second, accept that short-term corrections remain very possible because war risk, oil, inflation, and Fed constraints have not disappeared. Third, use dollar cost averaging to avoid missing the long-term move. Fourth, keep cash reserves so that a deeper correction becomes an opportunity rather than a crisis. Fifth, focus your research on the areas with asymmetric upside, not every shiny asset. Sixth, Separate core holdings from speculative plays. 7th, define levels and invalidation points before emotion takes over. 8th, understand that selling is part of the process. 9th, do your own research because borrowed conviction breaks under pressure. 10th, stay grounded. That is the framework. Now let us apply it for broad markets. A person in accumulation mode should not be fully sidelined if they believe the economy will be larger in 5 to 10 years and AI will reshape productivity. Being completely out of the market may feel safe, but it risks missing the compounding phase. For risk assets like Bitcoin, DCA with levels and risk control may be more rational than emotional all-in buying or emotional waiting. For altcoins and speculative crypto equities, a watch list approach is better than spraying money everywhere. For AI, related equities, follow earnings, capital expenditures, and infrastructure bottlenecks. For macro risk, watch oil and inflation. For trading, wait for conditions where the higher time frame and lower time frame align. For life, build financial reserves and avoid decisions that depend on perfect market timing. The opportunity may be large, but large opportunities attract bad behavior. They attract greed, they attract leverage, they attract overconfidence. They attract people who want to get rich without understanding what they own. That is why many people lose money in bull markets. They buy the wrong assets too late. They use too much leverage, they ignore exits, they confuse paper gains with realized gains, they believe every dip will recover. They assume liquidity will always be there. Then the cycle turns. So if this is a last chance at generational wealth, it is not a last chance to act stupidly. It is a last chance to prepare intelligently before the crowd returns. The phrase last chance creates urgency, but urgency must not become recklessness. The better framing is this: a major technological and monetary shift is happening. Most people are underprepared. Those who build ownership, knowledge, and disciplined exposure before the next major expansion may have an advantage. Those who wait passively may become consumers of systems they do not own. That is the real message. Now let us close the loop. The market has rallied because the worst-case geopolitical fear has eased. Earnings remain strong. AI optimism is intact and risk appetite is returning, but oil remains high. Inflation risk remains. The Fed may not be able to cut easily. The Middle East remains unresolved. Therefore, the rally is not a clean all clear, it is a fragile relief rally inside a larger structural opportunity. The best response is not to chase blindly. It is to build exposure systematically, keep cash reserves, research asymmetric opportunities, and act when your conditions are met. AI may change the labor market. Universal income discussions are a signal that powerful people expect disruption. Ownership of productive and scarce assets may matter more in the future. The 5 variables to watch are war risk, oil, inflation and rates, earnings, and AI optimism. The asymmetric opportunities are likely in assets where narrative, liquidity, relative strength, and catalysts align before the broader crowd returns. Bitcoin remains a core crypto signal. Higher beta wrappers and altcoins may offer upside, but require strict risk control. Meme coins and speculative vehicles may run, but they are not foundations. Research creates conviction. Conviction allows patience. Patience allows you to act without panic. But risk management keeps you alive. This is the most important thing. You cannot compound if you are eliminated. You cannot benefit from the future if you blow up in the present. So stay in the game, own the future intelligently. Do not wait for perfect certainty. Do not confuse relief with resolution. Do not confuse opportunity with guarantee. Do not confuse conviction with blind belief. Do not confuse a rally with safety, and do not confuse volatility with failure. The world is changing fast. The people who own the machines, the platforms, the networks, the scarce assets, and the financial rails may control a larger share of the next economy. If you understand that now, you can prepare. If you wait until everyone understands it, the opportunity may already be much smaller. That is why this moment matters. Not because the next month is certain, because the next decade may be shaped by decisions people make while everyone else is still distracted.